Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Sylvia Jablonski, Managing Director, Capital Markets, Institutional ETF Strategist at Direxion, to discuss what's driving the heightened volatility in the market. Sylvia, it's great to have you with us. Welcome back to Trade Talks. And there's just a lot to unpack here. So let's start with the election. Which sectors are impacted with a Trump or Biden win? And you're also paying attention to China as well.
Yeah, hi Jill. Thanks so much for having me again. It's really interesting to see what's going on with the election, and particularly in the short-term levered products, we really see the impact of that volatility and the increase in volumes of trading and things like that. So, I think it's going to go one or two ways. And if Trump remains president, it'll probably be more of the same. The corporate tax rate will remain low. Regulation will be lighter on things like in the energy sector. China tensions may continue to be strained. If there's a blue wave and President Biden, or if Biden becomes president, then I think you'll see some reaction maybe in things like solar, clean energy, and with China, I think just because of the heated negotiations that we have now, the future or change up in leadership could perhaps cool things down a little bit, and if some of the trade tariffs are agreed upon, and sort of the caustic relationship there fades off a little bit, we might have more of an open free trade and less tariffs situation there. So I think China could bounce on that election. But interestingly enough, if you look back in history, when President Obama was elected, the consensus was the market's going to pull back 10-15%. When President Trump was elected, it was the market's going to pull back 50%. Banks are going to fly, and energy is going to fly. And, lo and behold, the market was sort of trending upwards for the last decade. And actually, banks and energy are the weakest sectors over the last 4 years. So, I think a lot of it is priced in. I think what you get, though, is choppy markets, and that can be tricky to navigate.
Right. And I think part of the concern is, as you mentioned, you're seeing this in the shorter term products at Direxion, is that even if we get to November 3rd, what does the transition of power look like, whether Trump stays in office or Biden takes over the White House? And I think, it's Q4, and then of course you have to factor in COVID-19. We're starting to see an uptick in cases globally with the winter months coming. So I think there's a lot more to go, even beyond the November 3rd election day. So the question is, what do you like now?
Absolutely. And those are really awesome points. So I think, on that backdrop, because we still have this uncertainty of whether or not we're going to get more fiscal stimulus, whether or not we'll have a vaccine, what will happen with COVID, that uncertainty remains. And in my mind, that's also a really good opportunity. And opportunity in sectors like technology and semiconductors. I know that they're at very high valuations, but if you think cleverly and think about like which parts of technology could potentially rise, and you look at things like work from home types of products, we've got an ETF there, but the names in that ETF are things like CrowdStrike, triple digit returns since March lows, Twilio, triple digit returns since March lows. Past performance doesn't indicate future, but if you think about this, most workers have experienced some sort of disruption. Many of us are working from home, are partially working from home, or have some flexibility we didn't have a year or two ago. And a lot of that depends on the use of things like cybersecurity, the use of things like data, cloud management, online project management, document sharing, things like that, communication. We're Zooming here together today. So I think if you look at sectors or names like that and products that encompass those names, you're really getting in sort of in the beginning of this, because I think it's going to be a societal shift going forward.
Yeah, I would agree with you. And as you mentioned, many of those trends were in place prior to COVID-19, and they were obviously accelerated probably 3 to 5 years. I've heard people argue even 10 years. So looking beyond Q4, I happen to agree with you. I think that we'll see a hybrid role, if anything else, with these trends that are here. There's been a seismic shift in consumer sentiment, in the way we do business, in the way we think about travel. So what are your thoughts on volatility? Valuations, of course, is a great point, in particular with the Asian markets. What are you thinking for 2021?
So I think volatility will be really high. If you're using high conviction types of products, high beta, for example, I would look at those as short-term opportunities. For the longer term, for clients that are sort of afraid of the volatility, I would say stay the course. If you're invested in some of the tech and semi names, and you have some nice gains to recognize, it's reasonable to take some of it off the table. If not, if you have cash on the side and you'd like to buy on the dips, I do think that those sectors have a longer term story. So it's a matter of, do you need cash right now in the short term to generate some alpha? It's been working for you in names like Tech L, SoxL, the semiconductor indices that are out there with the big names like Apple and Microsoft. But in terms of positioning, like what names for the longer term could play out, again, the work from home, anything that has to do with a connected consumer, how you're consuming social media, how you're consuming gaming, entertainment, teledoc, health, things like that, looking for products that give you exposure to the names that help you entertain yourself at home, not only work from home, which we already talked about. Housing has been really interesting. So home builders, if you look at ETFs like, Nail, for example, or any of the, major home builders types of indices and products out there, Lennar, Home Depot, a lot of people have fled the urban areas and gone out to suburbia, bought homes, existing same home sales, or just off the roof. And I think a lot of us are also sitting at home looking at that light switch that needs a different color paint or whatever it might be. So Home Depot, Lennar, Toll Brothers, all of those names are really moving the home building indexes up in the short term. And I think also biotech. I mean, we don't have a vaccine yet. And all of these different companies, forget the backdrop of we already have such a high percentage of aging baby boomers that will need to consume, biotech products, medical services, healthcare services, things like that. You had all of these FDA pre-approvals and approvals, like cancer drugs are in the mix. So we don't even talk about that stuff. And those are major, those have major tailwinds. But not only that, one of these companies is going to come up with the cure, or maybe a few of them will, or the vaccine. And, getting some exposure to those names, because sort of like regardless of who it is, if it's a major move and a major component of one of the biotech indices, you'll probably generate some alpha there. So I think for the short term, again, like tech, work from home, connected consumer, home builders, if you're really sort of like well positioned and you're just worried about the volatility and you don't want to, just be 100% exposed in equities, I think looking to flight to safety, things like, long dated treasuries plus gold plus utilities, things like that, where you're participating but protecting, are also, totally reasonable to put into a portfolio.
Yep, something for everyone in this market, that's for sure. Sylvia, thanks so much for joining us on Trade Talks.
Thank you. Thanks, Jill.
You got it. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.